This video is sponsored by Toggle. What's the difference between an index fund, a mutual fund, and an ETF? And what does that mean for you? How do you know what kind of thing you should be investing in? In the next 8 minutes, you'll learn the differences between all of those and what kind of thing is right for you to invest with. Let's start with mutual funds. A mutual fund is just a managed investment fund that pools money from different people to purchase investments, and it's professionally managed. So it's saying people like me and you are going to put our money together. We're going to invest in this group of investments. But it's not just an arbitrary group of investments. It's not like you and I just picked a few stocks here and there. There's a professional who's in the middle as a middleman, and they have chosen this particular mix of things. So we go, hey, it's worth us investing our money with that person who's developed this mix of things, this little cocktail of investments, if you will. And so by going through that professional, we get access to all those investments all in one fund. It's a mutual fund because you and I and everybody else are mutually going in on it together. Now, it's important to note that it is professionally managed because there's connotations that go along with that. Some people like that because they say, hey, I want a professional managing my money. The professional knows what he's doing. Other people like myself don't like a professionals be involved because it means we have to pay them. So they get a percentage of the overall money that's in the fund as their pay, which means you're earning less money on your investments. You make less money because you got to pay that professional. Those professionals make money in a number of different ways, but part of it is that they're actively buying and selling different things to put in that fund. It's not like it's set it and forget it once and forever. They're constantly moving stuff around and they can charge based on every move. I don't like that because it means I'm not making as much money. But thankfully, there's another kind of mutual fund that's even better. That's an index fund. The biggest difference between an index fund and a mutual fund is that a mutual fund is managed by that professional and an index fund is not. For me, the word index doesn't make the most sense here, and so I'll explain what they mean by an index fund. Whenever something is tracking an index, think of it like a list. So this index fund might track a list of the 500 biggest companies, like the S&P 500, or it might track a list of financial companies like banks and investment companies and lenders and things like that. There's no professional involved with an index fund. It's just a passive thing. So somebody has set it up once, like an investment company. They've basically built out this thing to say, we want to track this list. We're going to set up this fund to do that job, and then it goes off on its own. That might seem like there's not a very big difference up front, but there really is a big difference. For one thing, unlike that active professional mutual fund manager, there's no one really to pay in the same way with an index fund. There's the company that set it up, but typically the fee there is just a tiny fraction of the fee that comes along with an active mutual fund. And the whole goal is different between the two funds because that index that was created, that list to say we want to invest in these things basically, is only ever going to match those things. It just does some of the legwork for you because instead of you picking 50 or 100 or 1,000 different companies to invest in and you figuring out how much to put in there, you can go to this index fund instead and you'll be investing in those exact things. The logic behind an active mutual fund is so different though. Someone investing in something like that is trying to outsmart that list. They're trying to say, hey, that would be fine if I invested in those things, but I'm actually convinced that if I do a bunch of the legwork myself and I make those decisions myself, then I'll be able to make more money than that. That's the logic. I think by the numbers, it rarely works out that way, but that's people's kind of overall goal is to outperform that list, aka the index fund. As far as the performance of those two, the index fund is a little bit more stable and predictable, where an active mutual fund is more variable as far as what's going to happen because you can't predict what a human's going to do. Maybe today this fund manager feels like buying a bunch of new stuff. You can't really account for that. You didn't know that was happening. It's happening. So that makes it less predictable. As far as index fund versus mutual fund, those people have access to the same investments. They're basically investing in the same things, but they're doing it in a different way. They're kind of going about it with a different perspective. So it's not like you're not going to have access to something because you choose one or the other. It's just sort of a different flavor and a different belief system that goes in behind it. I mentioned higher fees a little bit ago, and for the mutual fund, a typical fee for a mutual fund is close to 1%. The average that I looked up online is 0.82% as far as a fee for a mutual fund. That might not sound like a lot, but when you hear that the average fee for an index fund is only 0.09%, then you realize, wow, that's almost 10 times more money that I'm spending to pay this person to make these decisions that historically have made people less money. Okay, enough bashing on mutual funds. Let's talk about the difference between an index fund and an ETF. These two things are more closely related than the index fund was to the mutual fund. They're so closely related, it almost doesn't really matter to know the difference unless you're deciding to trade a lot. But let's talk about those differences now. For one thing, an ETF can be traded throughout the day. So the stock market is only open during stock market business hours because it opens in the morning and it closes every afternoon. And at any point during that trading day, you can be buying and selling ETFs. That's very different with an index fund because an index fund can only be traded at the end of a trading day. So even if you put in an order first thing in the morning to buy something with the index fund, it's not going to happen until the end of the day. So technically you're missing out on whatever happens throughout the middle of that day. We're talking about hours here. Hours of the price moving up and down, hours of people buying and selling. What can happen in hours? Sometimes a lot, oftentimes not that much. Something that is of consequence here is the minimum amount that you can invest in an ETF versus an index fund. For whatever reason, the way that these things are set up, an index fund sometimes has a big minimum balance that you have to invest with it. So like some of Vanguard's funds, for instance, have a minimum of $1,000 or $3,000 just to start investing in it. You can't get in there unless you've got that much money to invest on day one. Thankfully, here comes the ETF with a much more reasonable option because there's much lower, if any, minimum investment amount here, like maybe $1. And that's really significant to us because most of the time these things are investing in the exact same stuff. So you could find an index fund that invests in a certain list of companies or in kind of sectors like, oh, we do energy things or we do transportation things, whatever that list is. And then you could find an ETF that invests in the exact same things in the same proportions, but you don't have to have that minimum amount to invest. So you can get started sooner, which is better. I always recommend to people to get started as soon as possible. The more you can invest, the earlier you can invest it, the more you stand to gain. So don't wait. Don't think that you need to save up $5,000 to get started. Don't wait till you can meet that minimum requirement of the index fund. Just get started right now. There is a technicality in the way that these two things are structured that could save you some money on taxes, but I don't think it's that applicable for most of us. Whenever you want some money to get out of your index fund because you want to use it for whatever you want, you have an index fund, you're already investing in it, you just want to take cash out. Whenever that happens, you technically have to go through a middleman who's like involved in the structure of the index fund. And if you do that, and I'm invested in the same thing, I might get hit with some capital gains taxes even though I didn't sell any shares. You sold the shares. You took the money out, but I got hit with a little bit of taxes. Just found that in my shirt. The difference is that typically whenever you're selling an ETF, you're selling it to another person. Like I'm going to sell my shares and you're going to buy them. And so in that case, if I had made a profit on that investment, which hopefully I did, then I would get potentially taxed on that amount of profit. And there's nobody else involved in that ETF that's subject to any kind of tax. It's kind of a weird trickle down effect with the index fund thing, but I've never talked to anybody. I've never heard of anybody who was hugely affected by this. So I wouldn't be that worried about it if I were you, but technically that is a difference. So let's compare the three. We have a mutual fund that's a group of different investments that's put together by a professional who charges you quite a bit of money to do that. They also manage that fund. They're kind of always involved with it. They're always doing something with it. And you get to be a part of that if you buy into it. Both an index fund and an ETF are similar to the mutual fund because you get to go to one place and invest in a bunch of different stuff. For that reason, all three of these are good because I don't think that it's that wise to invest in just a few different things. Like if you want to pick individual stocks, I really like these 5 companies, I'm going to put my money in them. That's tremendously risky. Yeah, you might make a lot of money, but odds are you're probably going to end up kind of breaking even or losing money because that's just too narrow of a focus for you to get reliable gains over the long term. The beauty of a mutual fund, an index fund, or an ETF is that you're probably investing in 100 or 500 different companies all at the same time. So even if 10 of them do horrible or even go out of business, you've got 90 or 490 other ones that have probably made money this year, and so you're probably making money. That's the main reason why I typically advise people, even though that this isn't advice, this is entertainment on the internet, to go ahead and invest in funds. Whatever kind of fund you like. Mutual fund, index fund, ETF, exchange traded fund. That's what that counts for, but that meaning doesn't mean anything to me, probably doesn't mean anything to you either. All of these though are funds. And funds are fun. Fun funds. Okay. Dad joke's over. If all you invested in for your whole life are some kind of fund like these, that are these groups of different companies all put together in one simple place for you, you'll probably do quite well. If you want to optimize even more and make sure that you maximize your gains on top of using a fund instead of individual stocks, you can move to something like an index fund because it's got fees that are 10 times less than the average mutual fund, and typically it gets better returns. So your overall spread there will be great. Over the course of 10 or 20 or 30 years, you'll have a lot more money than somebody who went with a mutual fund in that case. And if you want to optimize even more, you can jump into ETFs right now, because odds are that index fund has some minimum amount that you have to save up to get started investing. That's such a buzzkill. Do not do that. Don't wait to get started. Just jump on an ETF. There's nothing wrong with ETFs. In fact, I would say most of our money is actually invested in ETFs. I personally don't use the kind of day trading feature of an ETF in that you can buy and sell it throughout the trading day. I don't find that useful. I know there's some people out there that this is really important to them because it feels somehow justified. Like, I want to invest at 9 a.m. My money is going to work for me starting at 9. It's punching the clock and I want it to go right now. I don't want to wait till the end of the day. So if that's important to you, then you should definitely look at an ETF. Overall, in the scheme of things, over the course of decades and decades, one day in or one day out of the market isn't going to make that big of a difference. But there's a really powerful psychological factor here where if you're investing in the way that makes the most sense to you, even if that's with the costly mutual fund, that's okay because you're investing. And it's way better than holding on to cash. And it's way better than buying gold or doing something else. And it's way better than spending all your money and just living as if there is no tomorrow, because you'll probably regret that. Now, a short time out to talk about Toggle. These are toggle switches. You could use them to switch things on and off, do some basic controls, and that's about it. Toggle is an investing tool unlike anything I've ever used before. It was put together by people who literally came from the world of Wall Street with all the wild, advanced tools and features that us normal people can't access. Times are changing and power is being democratized because Toggle gives you access to a ton of information and advanced tools that used to be reserved for the Wall Street pros. They take all that massive amount of info and process it constantly with the help of AI, historic trends, and thousands of data points, and they literally do millions of analyzing processes and things every day. It's nuts. Investing based on a hunch from your Uncle Lou or some Instagram post is not very wise. Leveraging the power of thousands of indicators and the objectivity of Toggle is probably much wiser. I also just find the service genuinely fascinating, and I actually use it myself. But here's the best part. For my subscribers, you get 1 month totally for free without a credit card. So you don't have to put in your info and then set a reminder to cancel this free trial in a month from now because you don't want to pay for it because you didn't like it or whatever. No. You can sign up right now, get access completely for free, no credit card required. Check out the link in the description to learn more about Toggle. This has been kind of an overarching summary of these things, but it's not 100% accurate because there are things like actively managed ETFs, which are like the opposite of the definition that I just laid out. But on the average ETF is not that. If you're considering jumping into some kind of investment, a lot of the tools nowadays have a built-in research section that you can look up these kinds of things and see, is it actively managed or not? And one dead giveaway for active management is if the fee is really high. If it's over maybe 0.5% or 0.8%, it's probably actively managed, so you'll know right off the bat. But odds are in your investing app, you can look these kinds of things up and type in the little symbol for whatever the thing is you want to invest in, do a little bit of reading, see if it's active or passive, see if there's a minimum amount that you need to get started or not. And if it doesn't meet the kind of criteria that you want, just find something else. There are plenty of things out there. You are not going to miss out because you can't invest in this one thing instead of that one thing. There's so many good options out there when it comes to investing that you can find something that works for you. I realize that's easy to say, but it's a lot more difficult if you're just getting started because you could still be like, hey man, I'm confused. I don't know where to start. I looked up ETFs and there's just this massive list of like 300 different ones. So which one do I pick? Well, if you want to get started and get some ideas kind of going through your mind as far as what you might be interested in, I made this video, which are my top 5 index funds for this year. These are things that I'm actually investing in right now that we have thousands of dollars in, and I think that they're pretty good. Ironically though, I call them index funds, and really I think all of them, or maybe almost all of them, are ETFs. But now you know the difference between those. So as you watch that video, you'll go, hey, these are ETFs. I know what that means. That's different than an index fund in these few little ways. So that's pretty cool that you know that now. Tap right here to see the top 5 index funds that I'm investing in this year.